All right, very good. Well, it's my honor to introduce Somerset Regal management team for Somerset Regal. We have Bill Taylor from the Somerset side and David Orbuck from the Regal side. So Somerset Regal just recently completed their standard conversion in somewhat a non-standard way, because you did a mutual conversion, which we hadn't seen one of those for a while. So that's where we get the name from the two banks, from Somerset and Regal. Their franchise is in a very attractive North Central New Jersey. We're very excited to have you here and to learn more about this newly available public stock in our space. So thank you. Perhaps we can just start. We're just going to have a conversation. I'm just going to say up front that we're using call report data as well as information from the prospectus. But perhaps we can just start with your introductions. Just tell us about yourselves and how you ended up teaming up together.
David, I'll go or you go?
You go first. I'll go after.
Okay. I'm Bill Taylor. I'm the chairman and CEO of the bank and CEO of the holding company. I've been with on the Somerset side for over 40 years. So.
And I'm David Orbuck. I'm the executive vice chairman of the bank, executive chairman of the holding company. I've been with Regal. I was initiated in the founding of the Regal Bank when we started in 2007. I've been with them since 2011, and used to be a former practicing attorney. So.
Okay, great. And can you talk about your footprint, your marketplace? About is there much overlap between the two banks, and how's the economy and real estate values trending just generally?
I'll take it, and David, I'll let you chime in. There's really only one overlap. We have one branch that's in the same town in Somerville, and that branch is going to consolidate into ours when we do the data processing conversion in March. I think the real estate values from our end in Somerset, Hunterdon, and Middlesex, the parts we're in, have been staying pretty stable for the most part. At least that's what we're seeing. So. David, I'll let you.
Yeah, and on the Regal end, we're two different sides of the business. I mean, Somerset Legacy was 1 to 4 family, so that's their market, and the Regal side was predominantly multifamily lending in New Jersey. And on the lending side, and what we've seen so far is the values have pretty much stayed healthy. With New Jersey being the most densely populated state, the proximity to New York City, and the large demand in multifamily housing has definitely pretty much held up even during this economic downturn.
I think that there had been some concerns about the state of New Jersey with their taxes and whatnot, but it has proven to be a very resilient state. Is that accurate?
Correct.
I'd say yes. Yeah.
Right. Okay. Well, good to hear. Yeah. Perhaps we can just talk about my estimates. Just again based on the call report and on the prospectus, I'm estimating for the third quarter tangible book per share, and this is with the conversion and the merger, so a lot of moving parts, of approximately $17. Does that sound ballpark?
Correct. Yes, it does.
So that would put us pretty close to where it was in the prospectus, which indicates that your fair value marks from the acquisition were pretty much as expected. Which is good, because with so much changing, so I think that's great. The call report also shows the fair value mark on the held to maturity securities looks to be approximately maybe $2.73 per share. So if people want to choose to adjust for that, then we're still at a tangible book of over $14.30. With the stock trading well at $8.50 last time I checked, which is just before the open, still very healthy discount to tangible book. It's a real opportunity. Just looking at the earnings in the call report, and I know this is the earnings for the bank level, and at the holdco there's going to be even more moving parts, but it looked like there had been some significant one-time expenses at the bank level. Look like a meaningful CECL reserve over $4 million pre-tax. and what I estimated to be around 4 million in pre-tax, probably like one-time merger related or conversion related charges.
That's approximately, that's pretty close, I think, but 3.5 to 4.5 million, but 4 is I think pretty close to that. So yes.
Okay. Again, at the holdco level, we're going to see charitable contribution expense. That's going to be meaningful over 5 million pre-tax. But again, these are all one time. So if I normalize for these one-time expenses, then I'm coming out with I'm coming out with over 4 million, around 4 million in base earnings from which to grow. Does that sound ballpark?
Yes, it does.
Okay, so it's good to have an earnings base out of the gate, right? And we'll have some, merger accretion, what we were talking about earlier today, some wind at your back, and so it's a good place to start from.
Right. If I may, you asked us before if I can just cut in about how we came together, and we didn't really answer that question. So yeah, I'll start, and David can fill in. We had talked about here on the Somerset side about trying to diversify our portfolio. We were 1 to 4 family lender, and obviously with rates being low, we thought we needed to do that. And we considered trying to do it on our own, and then KBW suggested that Regal came up as one of the potential candidates for us to talk to. And I think they said it at the same time with David, and we met at the end of 2021. And the one thing that struck us for both of us is our conservative lending culture. And David, I'll let you take it from here on that. So
yeah, correct. I mean, our market has always been, or our expertise has always been on the multifamily commercial real estate side, but predominantly multifamily. I don't want anyone to get concerned that we're in office space or anything like that. We do a lot of multifamily lending, mixed use lending, some owner occupied, but that's been my expertise when I was practicing as an attorney. I was a real estate attorney, and that's been all our lenders focus since we formed Regal Bank. And I said, just like Bill, we were looking for a strategic partner. We had bought a bank about 6 years ago, a small bank, and we were looking for something else to do. And being that we had our expertise in commercial real estate and multifamily predominantly, we were looking to align with another bank that had the other side of the balance sheet, not balance sheet, but the other side of the lending spectrum. And what Bill said is exactly correct. Not only did our regular personalities align, but our conservative lending focus and strict underwriting aligned very much as well. So it was pretty much a natural fit.
Right, and it seems natural and strategic. Good strategy. Can you just talk about, you're both pretty historic banks. You have deep roots in the communities, I'm guessing. Can you talk about your bread and butter type customers and what kind of relationships, how long kind of relationships are those?
David, you want to take this one first?
Yeah, I'll go first, just to mix it up a little bit. I mean, and apologies, because we just formed together. There's Regal side, Somerset side, until we actually get all combined. But on the Regal lending focus, we really operated 2 different types of circles. On the deposit side, we're a full-fledged commercial bank and retail bank. We have depositors from not only our branch network, but outside our branch network, because we have we have scanners and the full online capabilities, but we cater to homeowners, retail, business owners, and the broad spectrum of depositors. On the lending side, like I said, we pretty much just focus on the commercial real estate side, predominantly, overwhelmingly multifamily, and therefore our borrowers run the gamut, not just where our branches are located, but pretty much the northern half of the state of New Jersey. And we pretty much cast a wide net. So our bread and butter customers vary depending on the side of the balance sheet.
And from our side, we're almost entirely retail, and we have a lot of long-term customers. We did something a couple of years ago, and we determined that the average customer on the deposit side had been with us for 18 years. So we have a lot of people who've been with us a long time. They like our customer service, and obviously, as I talked about, we're a 1 to 4 family, lender. So they kind of went together. So knock wood, we've been lucky with that on the customer side. So.
And I'll just add as well, like Bill said, our depositors have been very, very sticky. We just let the high cost CDs run off, but everybody else pretty much stays put because we have a very good feel and touch within the communities that we serve. And people have been very, very loyal to us as well. And that's evidence if you pull up some of our prior call reports, you could see the high non-interest bearing deposits that we have even throughout 2022 and 2023 with the rising interest rates. People have pretty much stayed put in terms of that mix between non-interest bearing and interest bearing. So
I would like to mention your deposit franchise. It seems very low cost. I think I was looking at 77 basis point cost for interest bearing deposits and 71 basis points total deposit cost, and that's on the combined basis, right? So it seems low for the industry, low for New Jersey. Can you give us a feel for kind of how your deposits as a combined bank break down between retail, commercial? There's any kind of muni deposits or any kind of concentration type deposits?
David, you want to start with that one?
Yeah, I don't think we have a big concentration. I mean, because of, at least on the Regal side, that we vary depending on the product, whether it's the loan or the retail side. We have a very, very large mix of depositors that run the gamut from all products. We have some that have, non-interest checking, savings, CDs, the whole gamut of a relationship. And a lot of them are personal to not just me and management, but also the branches. Everybody's been here for a long, long time, almost since we start in terms of the branch managers, and they have a really good feel and tie within the community. So we get that. In terms of the municipals, we have very, very little. We just bank one county, not even a county, just one entity within our home market. So we don't really have a big concentration.
Yeah, on our side, we don't have big concentrations either. And, David said what I was going to say. Our customers have been here with us for a long time, and so have our employees. We have a lot of long-term employees, probably a good mix of over 20 years, especially at the branch level. I think that serves us well for our customers. They obviously like seeing the same people when they come in on a regular basis.
Right. Well, it's an impressive deposit franchise, and sometimes we see deposits being used to purchase stock in the offering. So I don't know. Are you able to talk to that? Like, have you seen deposit outflows because of that? Because of those purchases? Or?
We have. We knew there was some. They took it right from their accounts, and we weren't able to quantify what they wrote checks for, but there was a loss of that where people moved their money from their deposits to buying stock.
So that if we see, deposits going down in this quarter, in this fourth quarter, that would be potential reason.
Right.
Okay. I just wanted to ask on the loan portfolio. Appreciate the bread and butter what your customers are like. But in the prospectus, you mentioned that you had bought some loans. There were some purchase loans in the last couple years that total maybe around 100 million. I was just wondering if you could give an approximate balance of what's for purchase loans, and then just give some color on what kind of loans are those.
Well, this is mostly on our side. We have 7 correspondents, 5 mortgage brokers or 5 mortgage bankers, and 2 banks that we buy loans from, and we only buy them on a one-off basis. We don't buy them in packages. What they do is they will get a loan. They'll see what our rates are. They'll get a loan. They'll underwrite it, and they think that works for us. They'll send it to us. We will re-underwrite it and then approve it. And then tell them, okay, they will close it, and then they will sell it to us after all that's done. So, and we, it's not they don't keep the servicing. We get the whole thing, the loan and the servicing. So
Okay. And is that something you plan to continue doing, or?
yes, we have, we continue doing it right now. That the correspondents, they know our conservative underwriting, they're comfortable, and we're comfortable with what they're giving us. It's almost always in our assessment area. There may be a few exceptions here, but they're few and far between. They're outside our assessment area.
Okay, so they're local.
Yep.
It's really a different, like a more efficient source of origination.
Right.
Okay. All right. Yeah, and the call report showed very strong asset quality. I think it was 1 basis point non-performing, 0 net charge-offs. So the credit looks great, and you talked to real estate values earlier. Can you talk about your underwriting criteria, like your typical loan to value at origination, or what's the highest loan to value that you'd go up to, debt service cover, any kind of, if personal guarantees, any kind of underwriting?
Yeah.
Go ahead,
I'll start on the commercial side. I mean, historically, taking out this interest rate rising environment, we've always done 75% loan to value on a purchase, 70% max on a refi. The typical 1.25 debt service coverage, which is standard for the space that we're in. Personal guarantees, if it's over 10 apartment units, which is standard out here, if it's under 10 units, over 10 units, what's called the bad boy carve-out guarantees, where if they do any litany of bad acts, it springs to a full guarantee. And it's pretty much, those parameters are pretty much market over here. Over the last year or so, as rates have gone up, our parameters have tightened even more. So much because with interest rates and cap rates going up, the deals did not work at those values. So I'd say we're quoting deals now in the low to mid 60% LTVs at these interest rates. But everything that we've had, as evidenced by our strong non-performances or really lack of non-performing loans throughout our history, it's pretty much held up water, and we've always been very, very rigorous in terms of our underwriting. So,
and on our side, it's almost all under 80%. We do have some loans with private mortgage insurance, but it's a very small percentage. And I think if you would look, our LTVs are probably 70 and lower on most loans, and a lot of them even lower than that. So.
Okay. And I had a question from the prospectus that mentioned that Somerset, that you owned all of your branches, I believe. Is that the case with Regal?
No, Regal, we rent all our branches.
Okay. So, but the Somerset branches that are owned, I was looking at the dates. I think they're almost all before the 1980s or so. And you list the carrying value, the square footage. I mean, is it, I'm not a realtor or real estate, but it looked to me like it'd be fair to say there's some undervalued real estate held on the books.
No question about it. I don't know what the values would be, but I think, almost across the board on almost all our branches, we have undervalued real estate because of when we bought them. I mean, the latest one was the Manville branch in 2006. So most were way before that. Right.
Okay. And I can see I've been scanning the questions briefly. A lot of them do have to do with capital. So let's move on to capital. Again, my estimates for the third quarter is a TCE to TA ratio, so tangible common equity ratio of around 15%. If we were to adjust for the held to maturity marks, 13%. Does that sound, again, ballpark?
Yes, it does.
Okay. All right. So plenty of capital, especially with that risk profile, that we were just talking about, and plus earnings tailwind from the merger. We're not even building in any revenue enhancements from the merger. We're not building in any cost savings from the merger. This is just from the merger accretion math. So there's a potential from that too, to some extent. So you have excess capital. We can debate how much is excess, but there's definitely a lot there. Can you share with us your thoughts about managing that capital.
You know, obviously we have to wait a year to do buybacks, and you know, when that time comes, if it's accretive and all, we are going to buy back the stock, and we're going to do dividends. I don't think we have a percentage in mind for a dividend or anything like that, but you know, we've talked about it. The board's talked about it, that we will do buybacks.
Especially, yeah, with the stock trading. So,
Right.
so,
Correct.
I think
Right.
I saw a question come in. You know, clearly there's a real value proposition now. There's some very spotty history of the regulators giving permission for an early buyback if the stock trades below the issue price for a period of time. In my memory, they haven't done that for a while, but something, you know, the caller or the participant who asked the question, you know, just put it out there, usually
We asked our attorney about that, and
okay.
they said we have to wait 6 months, and you know, they said it could happen, but the regulators have been, like you said, there haven't been too many, you know, recently. I don't know when the last one was, but he said you can do it if you had that, but I'm not gonna give a lot of hope that it's done in this regulatory environment. So,
Right.
but that doesn't mean we're not going to take a look at it. We're not dismissing that as a possibility, you know, in the first 6 months or after the 6-month period. So,
right. Well, unlike other interactions with regulators, just making the query makes you look great. It doesn't matter what they say.
okay.
It's like getting denied is almost,
Okay.
you can be just as proud of that as if they
Okay.
say yes. So the important thing is to ask.
Okay.
The MRP shares, and again, I know now we're talking, you know, when the vote happens. Actually, there is some provision that you could do an early vote. Have you thought about your timing for your options vote? Do you think?
At this point, we haven't, but I'm sure that's going to be a subject that we're going to talk about at some point in time with the investment bankers and the attorneys. But we haven't had. I have to say we haven't had a discussion about that. So.
Right. Okay. All right. But at that point, whenever you have the options vote, you have the option of buying in the 4% MRP shares or issuing them. Do you have thoughts on that?
With approval, we're going to buy them.
Okay. And you need to get approval, huh? That's
right. We do.
Not, you can't just, okay. All right. And yes, and let me just see if there's other, while I'm lining up the Q&A, I do want to mention that we had good insider participation from you and your board and your management team in buying stock on the offering, but only the Somerset employees and management could buy. Can you describe that dynamic? Why the Regal in general were not able to, and when they can?
I'll let you take that one, David. Since
because it was a mutual conversion. Obviously, the Regal side we're not depositors of Somerset, and we weren't allowed to participate in that conversion. And because of the timing of the close of the merger, it happened right during the blackout period. So until our Qs are filed, anyone from the Regal side was not able to participate in either the conversion or buy shares in the aftermarket until we get past the Q and the blackout period, which should be sometime, I think, obviously later next week or mid to late next week.
Okay. So mid to late next week, the Regal employees and board who want to buy can.
Correct. I mean, any of our shareholders that were not part of management obviously had the right to buy in the aftermarket, not in the conversion, but any of the insiders, me specifically, and two of the board members that came along from the Regal side, were not allowed to buy, and we plan to buy once the blackout period is over.
Okay. Somebody asked an interesting question. Would you have preferred, hindsight's 2020, but would you have preferred to have taken stock instead of cash in the merger? Yeah. If you had, I don't even.
It's
I'm
kind of
smiling because
tricky.
that's a long answer.
It's a
well-
long answer, it's a loaded question too. So.
And it's
Let's just say-
hypothetical.
let's just
The
say
short,
I'll be
the short
buying-
answer is that's the FDIC, but basically they told us they said no to that transaction. To
Oh,
issuing.
okay.
So-
So it wasn't a choice anyway. but-
No, it wasn't a choice. It wasn't.
Okay, I remember a merger conversion here in Connecticut where the bank converting actually bought two banks at the same time. And it was First Connecticut, and one bank took stock and one bank took cash, and it was an interesting experiment to see what happened afterwards.
Yeah, we didn't have that option. It was.
Okay, all right, very good. Then we have a question on the loan marks, again, a topic of interest, not just for your bank, but across the board. Will those be in the queue?
Yes, they will.
Okay, all right, so, and I don't, if you want to make any comment about that, otherwise we'll just wait for the queue.
Well, no, I think obviously there's a concern, and I understand that on our 1 to 4 family portfolio because we have some low rate long-term loans. But I think if we looked at it as a whole, and I know your first speaker talked about this with the deposits, it's kind of overcome, but there's still a concern about, the loan marks on our side. So, but that will be disclosed in the queue.
Yeah, and on our side, all the commercial loans are 5-year fixed loans, and then they adjust after that. And the average, putting aside the last year with interest rates rising, the average loan term tends to be about 3.5 to 4 years because the typical process with the commercial real estate is that they refinance before the term is up, and either they refinance internally with us or they go to another bank and take out different proceeds. But because it's a 5-year fix and then it adjusts if anyone decides to wait the 5 years, the floor is the going in rate, and then it'll adjust above that based on the spread over treasuries or whatever we set it to. So it's a very, very short term in terms of loans.
Okay, all right, good. Well, again, we have that, and we have the loan mark, which is again, in certain interest rate environments, turns into that undervalued asset. One more. Let's see. We also have a question. On the going forward on a combined basis, do you want to change your loan mix? Do you want to reduce the 1 to 4 family, or what kind of thoughts do you have?
We do. We don't have any specific, but I think it's 55. It's 1 to 4 now, and I think we'd want to move that at least to 55, 45, if not higher. Commercial to 1 to 4 family. That doesn't mean we're going to neglect the 1 to 4, but I think one of the reasons we were interested in this transaction, doing it, is to get into that space, especially as well as Regal has done it. That's why the ultimate reason why we did this. So.
Yeah, and it's also a function of loan size. Our typical loan size is obviously greater than a 1 to 4 family size. So even just by natural progression, any loan we put on will help with that mix. So.
Right. Okay. All right. Good. And we also had a question about potential cost saves in the merger. Can you talk to that?
There may be a little bit, but we didn't do the transaction because there got to be, cost saves. We're looking at maybe 5 to 10% at this point in time, but because of the unique nature of the two banks, there weren't a lot of cost savings or overlaps that we've seen. So.
Okay. But there's always some.
Yeah.
So you said maybe 5 to 10, and just to clarify, that's on Regal's cost base.
Well, it could be on both, because it just,
Okay.
we're going to pick the right, people for the job, and there may be some from our side, but, we're still focused on that integration and finding the right people or person for each job at some point in time. So.
Okay, great. And I'll just throw this, I think I was estimating or just historically, Regal's cost base was around 12 to 12.5 million. So okay.
Right.
Okay, and I don't see, am I missing any questions in the queue that you see? I just want to make sure we get all the questions answered. Want to make sure I'm not missing.
I think we hit it all, yes.
Okay.
Oh, okay, great. Well, this was really informative, and we're really appreciative of you coming on, and I know you have a lot of shareholders, a lot of new shareholders.
Thank you very much for having us. And I will say to anybody who's on the line, once the Q is published, feel free to reach out to us with any questions that you have, or if anybody wants to set up a conference call, we're more than happy to do that with anybody once the Q is filed.
Yeah, it was a pleasure. Thank you.
It's so great to see a public company acting like a public company, talking with your public shareholders. So, that's very meaningful. We appreciate that.
Okay.
Yes, very good. All right.
Thank you very much.
Thank you. Thank you very
Yes,
much.
thank you very much.